Alrighty, so this is the 10th video on accounting and the second on the Maybe series. And in this video, we're going to be talking about an increase in our accounts receivable or in our accounts payable, right? Or a decrease in either one. You would just flip the numbers. So let's talk about what an account receivable is, right? So we know that our accounts receivable from previous videos are an asset, right? Because essentially, that is money that you're going to receive at some point in the future. So you sold something and someone promises you to pay you in the future. So that's going to be an asset, meaning that it's a future benefit to you, right? And the opposite is true for an accounts payable. That is a liability because you purchased something and the person made delivery of the goods, right? But you're just going to pay them at some point in the future. So because of that, that's going to be something that you're going to essentially have a future obligation to fulfill, right? So that would be a liability. Now there's one really important concept here, and that is on our income statement, and this is really, really important, on our income statement, we recognize revenue and expenses when the goods have been delivered. We do not recognize revenue or expenses. We do not recognize revenue/expenses when we get/pay cash, right? And this is a really, really important rule, right? So on our income statement, we recognize revenue and expenses when those goods have been delivered to us, right? Not when we actually get cash for those goods. So let's say that you buy a cup of hot chocolate for me, and I give you that cup of hot chocolate. At that point in time, I have to recognize revenue. It doesn't matter whether you pay me tomorrow or 2 weeks from now or right at that moment. We recognize revenue when our obligation has been fulfilled, right? So the goods have been delivered. I gave you the cup of hot chocolate. So because of that, we recognize revenue at that point in time. Similarly, let's say that we are purchasing something, right? We are going to recognize that expense once we get that item on hand. We don't recognize that as an expense when we actually pay cash for that item. And this is really important for our accounts receivable and our accounts payable, because that means that for our accounts receivable and for our accounts payable, we are going to recognize those on the income statement, right? And let's go through an example, and hopefully that makes it a bit clearer for you guys. So let's look at our, let's look at our income statement, right? And let's assume that our accounts receivable increases by 100, and there's a 25% tax rate. Right? We have our balance sheet here, and we have our cash flow statement. And I'm going to make a little simplifying assumption here, but I don't want you guys to worry about it too much. And what that assumption is that this increase in accounts receivable is not because we're selling some inventory. And I'm going to talk about that in probably the next video, right? So let's just make it really, really simple. We had an increase in our accounts receivable, but we talked about that being an increase in our revenue, right? When we look at our cost of goods sold, right, assuming that this is some inventory that we're selling, this is going to stay flat. And if that doesn't make sense, don't worry about it, right? We're going to talk about that in the next video. So that means that our gross profit is up by 100. We're going to subtract out our operating expenses. That stays flat. So our EBIT is going to be up by 100. We're going to subtract out our interest. That stays flat. So our earnings before taxes, otherwise known as our pre-tax income, is up by 100. And now our taxes. Because we made $100 more in revenue, right? Our accounts receivable increased, we made $100 more in revenue. We're going to have to pay taxes on that additional $100. So our taxes are going to be up. That was a bad arrow. Our taxes are going to be up by 25, right? Because 25% of 100, meaning that our net income overall is up by 75. Where do we go from here? We go directly to the cash flow statement. So we know that our net income is up by 75, but would it be accurate at this point in time to say that we have $75 more in cash on hand? No, right? We don't actually have $75 more as cash on hand because we have $100 that's going to be in accounts receivable. That's money that we're going to get in the future. So think about it like the example that I gave in a couple of like some of my earlier videos, right? If our assets go up, that is a use of cash, meaning that cash goes down, right? And if our liabilities go up, that is a source of cash, meaning that our cash goes up, right? And I've talked about this pretty extensively in a couple of the other videos. If this isn't intuitive to you, I'd definitely check out some of the videos on like the cash flow statement and how the three statements link together, right? So that's an important distinction to have, right? So under our cash flow from operations, our accounts receivable increased by 100, meaning that that is a use of cash, right? So this is going to be a minus 100, meaning that our overall cash is actually going to go down by 25. And let's think about this for a second, right? We have money that we're going to receive in the future, but we had to pay taxes on that today. So it makes sense that we have $25 less in cash, right? Because even though we're going to receive this $100 at some point in the future, we had to pay taxes today, so our cash is down by 25. Right? So let's move over to our balance sheet. Well, we know already that our cash is down by 25. Right? And we also know that our accounts receivable is up by 100. Right? That's essentially the premise of the question, right? So our total assets are up by 75, right? Hopefully you guys can see that. And we know that our net income flows through to our shareholders' equity, and our shareholders' equity has increased by 75. So let's check our golden rule again. Our assets equals our liabilities plus our shareholders' equity, and our assets went up by 75, our shareholders' equity goes up by 75, so the balance sheet balances. So that's how I'd kind of walk through an increase in accounts receivable. Right? So let's look at the next example around an increase in our accounts payable with a 25% tax rate. So we have our income statement, we have our balance sheet, and we have our cash flow statement. Well, if our accounts payable increased by 100, that means that our expenses increased by 100, right? So we know that our revenue is going to stay flat. I shouldn't skip steps here. Our cost of goods sold stay flat, so our gross profit stays flat, but our operating expenses increases by 100, right? Maybe this will be clearer if I make this in red, right? So let's make some of these line items in red so you guys can kind of differentiate a little bit easier, right? So our operating expenses increased by 100, right? So what does that mean for our EBIT? Well, that's down by 100. Our interest expense stays flat, meaning that our pre-tax income is simply down by 100. And now let's talk about our taxes. Right? Similar to the example in the video before, we have $100 less in our pre-tax income, meaning that we save $25 in taxes, right? So overall, our net income is going to be down by 75. It's not going to be down by the full 100 because we had that $25 in tax savings because we didn't have to pay taxes on that portion, right? We saved taxes because we have less income. So our net income is down by 75. We go to our cash flow statement and we see that our net income is down by 75. But similarly to the example that I gave before, right? We know that an increase in liabilities is a source of cash. And let's think about this really quickly, right? If I go to a restaurant and I buy a meal on a credit card and I spend $100 on that credit card, when I walk out of that restaurant, I have $100 extra cash in my pocket because I didn't actually pay the $100 at that restaurant. I'm going to pay that at some point in the future, meaning that I have $100 more in my pocket than I should, right? So that's why liabilities are a source of cash. And so under our cash flow from operations, we're going to see our accounts payable increasing our cash amount by 100, meaning that our overall cash actually increased by 25. And similar to the example before, this makes sense, right? Because we have $25 of taxes that we saved. So we're going to pay $100 at some point in the future, right? But right now, what we got is the tax savings, meaning that we have $25 more of cash on hand, right? So let's move over to our balance sheet, right? So under assets, you see our cash changed here, right? We have $25 more of cash. In terms of our liabilities, we know that our accounts payable went up by 100. And in terms of our shareholders' equity, well, we know that our net income figure here flows through to there, right? So we know that this is down by 75. So let's run a quick our quick formula here, right? So we have our assets equals our liabilities plus our shareholders' equity. So we know that our assets are up by 25. We know that our accounts payable is up by 100. And we know that our shareholders' equity is down by 75, meaning that, oops, this entire side is up by 25, and our balance sheet balances, right? So the way, just to very quickly review, the way that I would walk someone through this would simply be, if our accounts payable increased by $100, we're going to recognize $100 as an expense on our income statement, meaning that our pre-tax income decreases by 100. However, we have $25 of tax savings, so our net income is only going to be down by 75. That flows through to our cash flow statement. So we're going to start off with net income down by 75. However, because our accounts payable increase, that's a source of cash, meaning that we have $100 more cash in our pocket. So overall, our cash is going to increase by 25. On our balance sheet, we're going to see that our cash is up by 25, our liabilities are up by 100 because that's the increase in the accounts payable, and our shareholders' equity is going to flow through from our net income, which is going to be down by 75. So our assets are up by 25, our liabilities are up by 100, and our shareholders' equity is down by 75, meaning that the balance sheet balances. So that's essentially how I'd walk someone through the three statements for accounts payable. So hopefully at this point in time, you guys have a pretty good understanding around accounts receivable and accounts payable. And yeah, with that, we'll hop into the next video.